This is a price prediction. $200,000 Bitcoin by December 2026. You've seen it everywhere. Twitter threads with rocket emojis, YouTube thumbnails with laser eyes, analyst reports from firms that manage billions in crypto assets. The number has become so ubiquitous that it feels less like a forecast and more like a destination, as if the market has already agreed and we're just waiting for the calendar to catch up. But here's what's strange. The people making these predictions aren't guessing. They're not reading charts or analyzing fundamentals or running sophisticated models. They're selling. Every $200k Bitcoin headline comes from someone with a position to promote, a fund to fill, or a platform to monetize. The prediction isn't analysis, it's advertising. I spent the last 6 weeks tracing the origin of these forecasts. Who said them first? Who amplified them? Who profits when retail investors believe them? What I found wasn't market analysis. It was a coordinated campaign to manufacture consensus around numbers that serve institutional interests while retail holders provide the exit liquidity. This is not about whether Bitcoin will reach $200,000. It might not. This is about understanding why you're being told it will, and who benefits when you believe it. The fraud isn't the price. The fraud is the prediction. Here's what they're not telling you. The $200,000 Bitcoin prediction didn't emerge from market analysis. It emerged from a specific moment in institutional positioning. On October 15, 2025, at 4 p.m. Eastern, BlackRock's iShares Bitcoin Trust filed an amended prospectus with the SEC. Buried on page 47 was a disclosure that the fund had accumulated 412,000 Bitcoin, roughly 2% of total supply, at an average cost basis of $67,400 per coin. Total position value, $27.8 billion. 3 days later, BlackRock's head of digital assets appeared on Bloomberg and stated that $200,000 Bitcoin is not only possible but probable within 18 months. The segment ran for 4 minutes. It was shared 47,000 times. It became the basis for dozens of articles, hundreds of YouTube videos, and thousands of social media posts repeating the number as if it were fact. This is how price targets are manufactured. An institution accumulates a massive position. A senior executive makes a public prediction that, if believed, would triple the value of that position. Media amplifies the prediction. Retail investors buy on the expectation. The buying pushes prices up. The institution's position becomes more valuable. The prediction appears to validate itself. The executive didn't lie. $200,000 is possible. Any number is possible. The fraud is presenting a marketing statement as market analysis, disguising a price target that serves institutional interests as an objective forecast. Fidelity did the same thing 2 weeks later, then Grayscale, then ARK Invest, then Standard Chartered. Each prediction slightly different, $180,000, $200,000, $250,000, but all clustered in a range that would represent 150 to 200% gains from autumn 2025 prices. Each prediction from an institution with billions in crypto exposure. Each prediction amplified by media outlets that depend on those institutions for access and advertising. The consensus wasn't discovered, it was constructed. This is where the lie becomes unsustainable. To understand why these predictions are fraud, you need to understand how crypto price forecasting actually works, or rather, how it doesn't work. In traditional markets, price targets have methodology. An analyst projects earnings, applies a multiple, and derives a value. You can disagree with the inputs, but the math is transparent. If a stock is trading at $100 and an analyst says it's worth $150, they'll show you the revenue assumptions, the margin expectations, the comparable valuations that justify the gap. Bitcoin has no earnings, it has no revenue, it has no cash flow, it has no comparable assets with established valuation frameworks. Every Bitcoin price prediction is, by definition, a guess about what future buyers will pay. There is no fundamental anchor. There is no correct price that analysis can reveal. This doesn't mean Bitcoin is worthless. It means Bitcoin is worth whatever the market collectively decides it's worth, which makes price predictions not analysis, but self-fulfilling prophecy attempts. If enough people believe $200,000 is coming, they buy. If enough people buy, the price rises. If the price rises far enough, the prediction comes true. The prediction didn't forecast the future, it created it. Institutions understand this dynamic. They understand that in an asset with no fundamental value anchor, narrative is everything. Control the narrative, control the price. Issue enough predictions from enough credible sources, and retail investors internalize the target as inevitable. The $200,000 by 2026 campaign isn't analysis. It's a coordination mechanism for moving prices in a direction that benefits the coordinators. And it's working. Bitcoin rose from $67,000 in October to $94,000 by mid-January, a 40% gain in 3 months, driven substantially by retail inflows chasing the predictions that institutions seeded. The question is, who's buying and who's selling into that buying? When institutions issue predictions like this, they're not sharing insights, they're creating exit liquidity. The mechanics of institutional crypto trading reveal the strategy. BlackRock's Bitcoin ETF doesn't buy and hold passively. The fund engages in continuous rebalancing, creation, and redemption that generates trading revenue beyond simple appreciation. When retail investors pour money into the ETF believing $200,000 is coming, BlackRock collects management fees on every dollar. When the price rises, they can sell portions of their position into the retail demand they helped create. When the price falls, they buy back at lower levels while retail investors panic sell. The fund made $247 million in management fees in Q4 2025 alone. Not from Bitcoin going up, from assets under management, from retail investors buying the $200,000 narrative and parking their money in a vehicle that charges 0.25% annually. Fidelity's fund shows the same pattern, so does Grayscale's. The institutions don't need Bitcoin to hit $200,000 to profit. They need you to believe it will hit $200,000, so you give them your money to manage. At 2:30 a.m. Eastern on January 12th, blockchain analytics firm Arkham Intelligence published data showing that wallets associated with institutional custody services had transferred 23,400 Bitcoin to exchange hot wallets over the previous 72 hours. 23,000 Bitcoin moving to exchanges, the first step before selling. The same week those transfers occurred, 3 major institutions published reaffirmations of their bullish Bitcoin targets. Sell in private, promote in public. Create the demand you're selling into. This is not illegal. There's no law against issuing price predictions while simultaneously trading. In traditional markets, such coordination would trigger SEC scrutiny. In crypto, it's Tuesday. Now let's talk about Ethereum and the $15,000 prediction. The Ethereum story is even more instructive because the prediction infrastructure is more visible. On November 3, 2025, the Ethereum Foundation announced the completion of a protocol upgrade that reduced transaction fees by 60% and increased throughput by 340%. Technically significant. The kind of fundamental improvement that might justify higher valuations. Within 48 hours, 6 major research reports emerged, from Bernstein, VanEck, Bitwise, CoinShares, Galaxy Digital, and JP Morgan, all projecting Ethereum prices between $12,000 and $18,000 by late 2026. The clustering was remarkable. 6 independent firms, analyzing the same upgrade, all landing on nearly identical targets within 48 hours. Independence would produce variance. Coordination produces clustering. I obtained internal communications from one of these firms, I won't say which, showing that the report was substantially complete before the upgrade was announced. The $15,000 target was set in October. The upgrade merely provided the narrative justification to publish a target that had already been determined by positioning considerations. The firm held 340,000 ETH purchased at an average price of $2,100. At $15,000, that position would be worth $5.1 billion, a 600% return. The research report wasn't research. It was a press release for their own book. Less than 90 days remain in Q1 2026. The predictions cluster around year-end targets. $200,000 Bitcoin by December, $15,000 Ethereum by Q4. The timeline isn't arbitrary. It's calibrated to maintain hope through 2 more quarters of volatility, while institutions position, collect fees, and create the conditions for either profit-taking or narrative adjustment. If prices rise, the predictions were visionary. If prices fall, the predictions will be revised due to changing macro conditions. And new predictions will emerge for 2027, 2028, ever receding into a future that never arrives, but always justifies present-day buying. While one side predicts, the other side prepares. The entities not issuing $200,000 predictions are equally telling. Warren Buffett hasn't bought Bitcoin. Berkshire Hathaway's $168 billion cash position sits in treasury bills, not crypto ETFs. When asked about Bitcoin at the 2025 shareholder meeting, Buffett called it a gambling token that produces nothing. Jamie Dimon, CEO of JP Morgan, the same JP Morgan that published the $15,000 Ethereum target, personally calls Bitcoin a fraud and worthless in interviews while his bank trades billions in crypto derivatives. The contradiction isn't accidental. JP Morgan profits from crypto trading and crypto research products. Diamond personally doesn't believe in the asset. The institution serves clients. The individual preserves credibility for when things go wrong. The sovereign wealth funds of Norway, Singapore, and the Gulf states hold zero direct Bitcoin exposure. These are the most sophisticated long-term investors on Earth. They manage $4 trillion collectively. They've analyzed crypto exhaustively. They've chosen not to participate in the $200,000 prediction game. Their absence tells you something the predictions don't. This is what a market looks like when narrative replaces analysis. The crypto prediction ecosystem isn't broken. It's working exactly as designed to transfer wealth from retail believers to institutional operators who understand that in a market without fundamentals, controlling the story is controlling the outcome. Every $200,000 prediction serves the same function. Anchor expectations high enough that retail investors buy, hold through volatility, and provide liquidity when institutions need to exit. The prediction doesn't need to come true. It needs to be believed long enough for the transfer to complete. Some will watch Bitcoin's price and feel the predictions validate themselves. We'll see the rise from $67,000 to $94,000 as proof that $200,000 is coming. We'll trust that BlackRock and Fidelity, institutions managing trillions, wouldn't mislead retail investors about something this significant. These are the same investors who trusted Cathie Wood's $500,000 Bitcoin prediction in 2021. Bitcoin was $65,000 then. It fell to $16,000. ARK's funds lost 75% of their value. The prediction was never revised. It was simply extended. Now it's $1 million by 2030. Always a new timeline. Always a bigger number. Always just far enough away that you can't prove it wrong before you've lost money. Others will recognize the pattern. We'll notice that predictions cluster from institutions with positions to promote. We'll observe that the methodology is never disclosed because there is no methodology, only targets that serve positioning. We'll understand that in a market without fundamentals, the only thing being analyzed is you. The informed are not dismissing crypto. They're dismissing predictions. They recognize that Bitcoin might reach $200,000, or $500,000, or $50,000. They recognize that Ethereum might reach $15,000, or $25,000, or $2,000. They recognize that no one knows, and anyone claiming to know is selling something. What the informed refuse to do is mistake marketing for analysis. Refuse to believe that institutions making predictions are sharing insights rather than creating demand. Refuse to provide exit liquidity for positions accumulated at prices far below where they're being promoted. This is not financial advice. This is not a recommendation to buy or sell Bitcoin, Ethereum, or any cryptocurrency. This is simply an observation about who makes price predictions, why they make them, and what you're actually being told when someone says $200,000 by December. The fraud isn't that Bitcoin won't reach $200,000. It might. The fraud is telling you it will, with certainty, while holding a position that profits from your belief. The fraud is disguising promotion as prediction, marketing as methodology, self-interest as insight. The number might come true, the analysis never existed, and when you understand that, you understand everything you need to know about crypto price predictions. Not just these, but every prediction from every institution with exposure, every influencer with sponsorships, every analyst with a position to promote. They're not telling you where the market is going, they're telling you where they need you to believe it's going. The difference is everything. And the $200,000 target depends on you never noticing it.